Hello and welcome to BloombergQuint. I'm here at the offices of HCL Technologies to take stock of the quarter gone by, and it's been a very steady performance for HCL Technologies with the headline numbers largely in line with Bloomberg consensus. What we've also seen is, outperformance in certain verticals. But to take stock of the quarter gone by and what we can expect in terms of the outlook, I'm here with the management of HCL Technologies, the CEO, Mr. C. Vijay Kumar, and the CFO, Anil Chanana. Thanks for joining us, guys. I'm going to start off with what really stood out for me in the quarter, and that's the engineering and R&D services. We've seen about 13.6% constant currency growth here. Much has been spoken about intellectual properties providing scale in this particular services segment. I want to know, will this be the growth driver for you over the next 3 to 4 quarters?
Engineering services has been one of our strongest service lines for several years. And this quarter, if you really dissect our performance, there are two elements which has really caused a significant outperformance. Right. We have an offering called Geometric PLM, yes, which actually was a part of the acquisition that we did with Geometric. We won several deals. All of them got executed in the PLM services space. So that's one big contributor. Second is we continue to invest in inorganic strategies, right, like IP partnerships, and that's also contributed a good number to the growth. Right. And all of this is also helping the core business of engineering services, because there are professional services, there are a lot of add-on services which you can look at in the engineering services due to the IP partnership and the engagement that we have with our technology partners. Right. CVK, as you may imagine, there will be concerns with respect to infrastructure services. We continue to see some slackness there, and there has been a lot of talk about delay in decision making. My question then is, what do you make of clients and their conversations? What's going on right now? Yeah, I think, infrastructure services, the fundamental driver for growth has always been large ITO deals. Right. And last year, or towards the end of 2016 and most parts of 2017, large ITO decisions were getting delayed due to change in the political environment. There was a hold pattern for some time, and last quarter I said we are seeing that change. So in the past quarter, we signed a very large infrastructure services deal for a consumer goods company, and we do expect it to continue. And once you sign the deals, for it to demonstrate or move into revenues, it takes at least 3 to 4 months. Right. So we remain positive on our booking. In fact, this quarter, the past quarter, we had the highest booking, the total highest booking for the past 12 quarters. Right. So we are optimistic. Infrastructure services specifically, as I said, we expect to get to a good growth in FY19. Right. I think you should give us a couple of more quarters before you expect a good growth in infrastructure. Okay, so a couple of more quarters. Anil, again, you guys are very well into your guided, margins band of 19.5 to 20.5. But my question then is, we've seen a little bit of a movement in the dollar. I'm sure that's not too much of a problem right now, but as we move into the next couple of quarters, what are the possible challenges that can threaten your margins? And I'm not saying that, of course, you'll come up with a different guidance by the end of the fourth quarter. But if you could just tell us something about factors that could threaten margins going forward.
So I don't see any threat to the margins. I think we are in a very well set range, which is 19.5 to 20.5. Right. Actually, we are right in the middle. I mean, if you adjust it for the currency, that was the guidance which was given at 65 rupees and 50 paisa to a dollar. Yes. And the other currencies also have moved. This quarter, there is a 10 bips impact because of the currency. But otherwise, we are well within that range, and we do hope that we'll stay within that range. Okay. And any excess profit we earn, we will sort of invest back into our business. Yeah. All right, great. So then in that case, in terms of growth, again, I've been reading about reports which suggest that growth for HCL Technologies is going to be largely back-ended. That is coming in the second half of the financial year. If you could give us a little more about whether or not you can expect that growth to come back in the final quarter of this financial year. Yeah, but whatever we grow, whatever growth we deliver in the last quarter is going to make a very little difference so far as the overall full year number is concerned. Right. So we do believe that we will continue to be at the lower end of the guided range, which is 10.5 to 12.5.
Okay. All right.
Yeah, but as Vijay explained, the deal wins which we had, I think they give us a good visibility into moving into FY19.
Okay. All right. Great. So my next question was to do with financial services. Again, in comparison to some of the other listed peers, where HCL Technologies done slightly better, but what's going on here with respect to, the contracts and the deals? Because is this more about transforming business, and in comparison, what kind of traction are you seeing from traditional services?
See, our financial services has been a great several quarters of performance. If you look at our CQGR for the last 6 quarters, it's all about 3% in financial services. And what is it? Which means it is not just a one-off. There is a systematic way we are continuing to grow, and there is something validates the differentiated strategy there. Financial services, all large financial services firms continue to reduce their spend in the traditional areas, and reinvest that into digital solutions, building a completely new stack based on OpenStack and some of the new technology stacks that are available. And we are very strongly participating in the transformation in this financial services organizations. I think that's in my view, the single biggest element. The second element is even on the traditional spend. While there is a lot of expectation on what automation can bring, we have delivered significant cost savings for our customers, driven by our automation platform, which is Dry Ice. And that's also resonating very well and help us win some of the traditional businesses as well, which the current incumbents are not able to deliver that level of optimization. We've been able to do it through Dry Ice. And that's also opened up a couple of pretty large financial services firms in continental Europe. So this gives us, while the last 6 quarters has been good, we continue to feel positive about how this can change in the next few quarters as well.
Okay, CVK, in my research, I came across this one fact, and you can please correct me if I'm wrong, that organic growth for the company, and that is, I'm talking about excluding the acquisitions over the past 1 year, has not been as robust. Now, my question then is this more systemic, and is this to do with the industry as a whole? Or are there challenges that HCL Technologies is grappling with? And in that case, will acquisitions then spur growth going forward?
The answer is both. I think since we've had very good bookings, in fact, historically the highest booking, we continue to feel very positive about how we can do organically. But given the state of the industry, it's very important for you to look at what are the right investment areas, what real capabilities that you will need to scale and continue to be relevant, especially around the Mode 2 and Mode 3 offerings. So we are continuing to pursue inorganic options. We have a very healthy pipeline of inorganic targets for FY19, and both organic and inorganic, both together gives us the confidence and the optimism as we get into FY19.
All right, just a couple more questions, guys. Anil, again, you guys just carried out a buyback recently. Any plans on what you have with respect to the cash generation that comes through the company now?
Sure. So if you look at our capital allocation policy, about 50% of the net income, traditionally we have been, about 50% of the net income, we have been paying out either in the form of buyback or dividends. So because we have a usage of cash. So we do have a pipeline of both organic as well as inorganic deals. So we do believe that by doing some inorganic deals, we will be able to sort of create a more impact into the marketplace.
All right. Well, finally, CVK, the information services group did show did indicate a substantial uptick in deals coming through. Gartner's also indicating an increase in spending. But there are concerns in the market out there that this is to do with the entire industry. This doesn't trickle down so much to companies which are based in India. What is your observation here?
I think it's completely a capability game.
Okay.
Right? If you have strong capability in digital analytics, and especially in cloud, right? A lot of traditional players have not spent enough time in building the right partnerships and capabilities. They're going to struggle. And 6 quarters back, we recognized the 4 strong areas where we need to invest in. We have put a very strong leader behind each one of them. We are doing all the right investments, and that's what is helping us win. And if our booking has been fueled by Mode 2 and 3,
right.
And even in this quarter, our Mode 2 and 3 revenues exceeded 25% of our revenue. So I think it's a serious uplift in the new services.
Okay, any chance that Mode 2 and Mode 3 services can move up to, I don't know, if you could give us just a ballpark figure of what it will look like?
We expect it to get to 35 to 40% in the next 2 to 3 years.
Okay.
And that's really just a kind of a direction that we're working towards.
All right. Well, gentlemen, it was a pleasure speaking with you. Thank you very much for your time.
Thank you.
Thank you.